The regular trading session for U.S. equities concluded on May 20, 2026 at 4 p.m. EDT, with Micron Technology Inc. finishing at a closing price of $731.99 per share, marking an aggressive intraday surge of 4.76%. This sharp upward advance added $33.25 to the stock value over the single trading session, pushing the company's total market capitalization to an eye-watering $825.49 billion. This aggressive intraday movement directly defies the broader cautious undertone whispering across the semiconductor space right now. The prevailing public expectation is that memory manufacturers are simply cyclical component suppliers bound to a legacy boom and bust dynamic, making this near 5% surge seem like a short-term anomaly. However, the reality hidden beneath this rapid volume accumulation points to a far deeper tectonic shift. Wall Street is quietly reassessing Micron not as a commoditized memory producer, but as an indispensable infrastructure bottleneck for the next half-decade of hardware expansion. While the average retail trader assumes this volatility is driven by casual retail momentum, institutional desks have spent the week reacting to severe structural constraints in the global supply chain, turning a boring hardware company into a focal point of defensive capital positioning. To understand why this closing price of $731.99 matters so deeply right now, you have to look at the immediate backdrop of the global memory market. The consensus narrative across online investing circles has been that memory stocks ran up too far, too fast, gaining massive multiples over the past 12 months and sitting dangerously close to their 52-week highs. Many assumed a steep correction was overdue, especially with macroeconomic yield pressures heating up. Yet the underlying data reveals a massive expectation versus reality mismatch. On the very week that broader tech indexes showed signs of exhaustion, prominent analyst institutions, including Mizuho and Citi, aggressively updated their price targets, driving massive capital inflows into Micron stock. Mizuho bumped its target to $800, while others pushed their projections as high as $1,000 per share. This target reassessment isn't just arbitrary optimism, it is an acknowledgement that high bandwidth memory, or HBM, is completely sold out for the foreseeable future. The traditional cyclical memory model assumes that whenever prices rise, manufacturers simply ramp up production, flood the market, and crash the spot price. The reality today is that structural manufacturing complexities mean supply cannot easily catch up to demand, leaving companies facing severe inventory deficits across all primary market segments. This supply gridlock is being amplified right now by looming external disruptions that could send a shockwave through the entire sector. Analysts are closely tracking breaking developments in South Korea, where tens of thousands of workers at Samsung Electronics are on the brink of a major walkout following a breakdown in profit-sharing negotiations. Because Samsung, SK Hynix, and Micron effectively control the global dynamic random access memory market, any minor operational pause at a competitor instantly shifts pricing leverage directly into Micron's hands. Industry modeling suggests that even a brief multi-week disruption at a competitor could trigger a massive cascade of panic buying from hardware buyers, driving contract prices for standard DRAM and enterprise NAND flash significantly higher. This is the exact type of structural catalyst that large institutional individual brokerage firms look for when allocating capital. They aren't looking at generic technical charts, they are looking at the stark reality of physical silicon supply. When you track how sophisticated funds manage an online investment strategy, they look for inelastic demand scenarios, and right now, enterprise buyers literally cannot build servers or deploy premium chipsets without the exact high-density memory modules that Micron produces. If you peel back the layers on recent institutional activity, the volume trend over the last few trading days highlights an intense accumulation pattern. While short-term retail accounts often use a mobile app to chase quick daily swings, professional fund managers utilize self-investing tools and dedicated investment sites to scale into large positions when a stock pulls back from its peak. Micron recently experienced a brief, sharp 2-week pullback of roughly 14% from its all-time highs, causing widespread panic among casual observers who assumed the chip rally was over. Instead of signaling a structural top, that dip acted as a liquidity magnet for asset managers who viewed the price drop as a massive valuation disconnect. When you look at the fundamental metrics, the company is trading at a trailing price-to-earnings ratio that appears elevated, but its forward price-to-earnings multiple drops down to single digits when measured against projected fiscal earnings. That structural gap between trailing historical costs and forward earnings power is precisely what keeps the market's expectation locked in a state of constant tension with reality. The market expects a cyclical peak, but the forward earnings revisions are telling a story of sustained, highly profitable growth. This brings us to a fundamental question that every investor needs to ask when evaluating how to allocate capital across different investing sites or when setting up an intelligent portfolio. Comment below how many shares of Micron Technology you currently hold, or if you prefer sticking to broader technology exchange funds to capture this hardware trend. Getting your perspective helps gauge whether retail sentiment aligns with what the big institutional desks are doing behind closed doors. When analyzing how this company operates, its business model centers on two primary pillars of technology: dynamic random access memory, which provides temporary workspace for computing systems, and NAND flash storage, which retains data securely when power is turned off. Historically, these two products were treated like pork bellies or crude oil. Prices rose when supply was tight, factories overproduced, and prices cratered. The structural shift that changed everything is how modern compute architecture is designed. In legacy computing, memory was an afterthought compared to the raw speed of the central processing unit. Today, the core limitation in advanced computing isn't processor speed, it is data latency. If a premium graphics processor has to wait for a legacy memory module to feed it data, the expensive processor sits idle. To solve this bottleneck, the industry transitioned to specialized architectures like HBM, which stacks memory layers vertically and connects them directly to the processor via ultra-wide interfaces. This design requires incredibly precise manufacturing processes, resulting in much lower production yields compared to standard consumer components. Consequently, even if a company wants to aggressively flood the market with supply, the physical limitations of manufacturing prevent them from doing so overnight, fundamentally breaking the historical commodity cycle. Looking back at older reports, the company's financial turnaround over the past few years has been nothing short of staggering. In previous downturns, memory pricing collapsed so severely that manufacturers were forced to take billions of dollars in write-downs, bleeding cash just to keep fabrication facilities running. But during the recent financial periods, including the late 2025 and early 2026 earnings cross-sections, the company posted massive revenue beats that completely shattered Wall Street's expectations. In its last major financial quarterly release, the company reported an actual earnings per share of $12.20, obliterating the analyst consensus estimate of $8.60 by more than 41%. Revenues surged to historic highs, driven almost entirely by data center demand and premium enterprise margins. This massive earnings surprise proved that the pricing power enjoyed by the company wasn't temporary. It was a direct reflection of contract price increases that enterprise customers were forced to accept to secure their component allocations for the year. This historical execution is what gives analysts the confidence to maintain their strong buy recommendations across major investment help platforms. When evaluating how to deploy capital today, whether you are using a self-investing brokerage account, checking option chains on a dedicated trading app, or relying on algorithmic rebalancing through an automated advisor, the main point of contention remains the sustainability of this capital expenditure cycle. The bearish expectation is that hyperscale data center operators will eventually hit a ceiling on their infrastructure spending, leading to an immediate freeze on component orders. The reality, however, suggests that the competitive dynamics of infrastructure development make it almost impossible for any single player to slow down without permanently losing market share. If a major cloud provider stops purchasing high-density memory modules, their service offerings immediately fall behind competitors who are building faster, more efficient clusters. This competitive pressure creates a highly resilient demand curve that is relatively insulated from short-term macroeconomic hiccups. Even as broader bond yields rise and create choppy trading conditions for high-growth tech stocks, the underlying operational necessity of acquiring physical memory hardware remains unchanged. Looking towards future scenarios, the company faces a clear binary set of catalysts and risks over the next 12 to 18 months. The most immediate upside opportunity relies on the ongoing execution of their domestic manufacturing expansion, supported by federal grant allocations aimed at rebuilding semiconductor self-sufficiency. If the company can successfully bring domestic fabrication facilities online ahead of schedule while maintaining high manufacturing yields, their profit margins will expand even further due to minimized logistics friction and localized corporate partnerships. Conversely, the primary risk factor centers on execution limits. If manufacturing defects or yield issues crop up during the ramp-up of their newest lithography processes, it could leave the door wide open for international competitors to capture critical enterprise contracts. This delicate balance between operational execution and structural demand is what makes the stock a fascinating case study in expectation versus reality. The market expects flawless execution because the demand is clearly present, but any minor operational misstep will be met with immediate sharp volatility. As we look at the broader landscape of online investing, many market participants wonder how to position themselves around a stock that exhibits this level of institutional momentum and structural volatility. Some choose to build direct exposure via an individual brokerage, using a retail platform like Robinhood Stock Trading to buy fractional shares or execute short-term option strategies during high-volume earnings weeks. Others prefer a more diverse, systematic approach, looking at established options such as Fidelity investments, utilizing specialized mutual funds or targeted exchange funds to gain exposure to the broader semiconductor ecosystem without betting the house on a single ticker symbol. Whether you manage your capital via specialized active investing platforms like SoFi Invest or utilize international multi-asset systems like Interactive Brokers trading setups, the core thesis remains identical. You are making a definitive bet on whether the structural global memory shortage is a long-term economic shift or just another temporary peak in an unyielding commodity cycle. In final assessment, the story of the semiconductor giant is defined by the permanent friction between legacy investor assumptions and structural modern realities. The closing price of $731.99 reflects a market that is actively waking up to the realization that the historical patterns to trade memory stocks might be completely broken. The expectation was that the company would peak and roll over as it always did in past decades. The reality is an unprecedented supply deficit, backed by a potential strike at a key competitor, and massive structural demand that shows zero signs of easing. While short-term macroeconomic headwinds and fluctuating treasury yields will undoubtedly cause periodic drops, the forward-looking data points to a company that has successfully positioned itself as an unbypassable toll booth on the high-performance computing highway. True market authority comes from looking past the daily noise of stock trading tickers and understanding the physical flow of goods. As long as supply remains tightly constrained and enterprise buyers continue to scramble for inventory, the underlying fundamental narrative will continue to challenge the skeptics, proving that reality can comfortably outrun even the most ambitious market expectations. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, bell subscribe for more updates.